Hello, everyone, and welcome to today's session. Thank you for joining us. My name is Thijs Hupkes, and I'm part of ESR's Fund Management and Capital team. I hope you enjoyed our new ESR Group corporate video that you've just seen on the screen. It tells the story of how we are always transforming to meet the needs of new economy with our development, investment, and fund management capabilities. The topic of today's session is investing in a fragmenting world. We aim to provide you with valuable insights and perspectives into the current global economic landscape and its impact on the real estate capital markets. I will now introduce the agenda of today's session as well as our speakers. We will kick off with a presentation from ESR Group's Head of Research and Analytics, Dr. Chua Liang. He will discuss the impact of trade fragmentation on the APAC real estate markets. Thereafter, Amélie Delaunay, Senior Director Research and Professional Standards at ANREV, will present about the APAC's non-listed real estate fund environment in uncertain times. Then we will have a panel discussion moderated by Josh Dage, ESR Group Chief Investment Officer, and he will be joined by Stuart Gibson, our Group Co-Founder and Co-CEO, Phil Pearce, the Chief Executive Officer of our Australia platform, and Jay Murphy, Head of Singapore Development and our Thailand platform. At the end of the panel discussion, there will be time for Q&A. If you would like to ask a question, please select the Q&A button on your Zoom screen, and you can submit your question there. And please note that questions may be submitted at any time during the session. So with that, I will now hand over to Dr. Chua to start his presentation.
Thank you, Thijs, and a very good afternoon, everyone. Thanks for joining us today. Now, over the next 10 minutes or so, I'd like to share with you my recent thoughts on a trend that's been, keeping me awake at night. That is the fragmentation of global trade that the deterioration in geopolitics has exacerbated. Now, I first flagged out this issue of trade fragmentation and deglobalization as early as 2022. Now, recently, the World Trade Organization conducted an extensive examination of these global trade tensions and published their findings in their annual Global Trade Report in September last year. Now, in that report, the facts and figures unequivocally confirm that trade, which had been on a globalization trend, has now been confronting significant fragmentation risk. Now, this is really not a novel issue in my view. In fact, the world has witnessed two previous periods of globalization and fragmentation. Unfortunately, we do not have time to go through this in details, but you can check out more in my paper published back then. So when or why did this fragmentation happen? Well, to me, there are actually four reasons. And again, in interest of time, I only explore two with you today. Now, global trade, as measured by the percentage of goods and services to GDP, began to slow as early as 2012, and that's 6 years before the onset of the US-China trade war. Now, this was inevitable because as global tariffs, especially in goods, reached a historic low by about mid-2010, what's left was then services, which are much harder to standardize and control. And global trade was further weakened by the US-China trade war 8 years later, when the US finally awoke to the ideological differences with China. This is the second issue. Now, when I said awakening, it's important to note that these ideological differences have always existed. So what precisely are these disparities, you may be wondering? Now, on the one end of the spectrum, we have the laissez-faire policies favored by liberal democratic America. And in contrast, we have China's preference for a status mercantilist Leninist approach. To put it simply, it's a clash between the free market capitalism and socialism with Chinese characteristics. Now, the divergence in ideology isn't a recent development. It has been an underlying current in the relationship between these two nations right from the beginning. Now, initially, the US believed that as China engaged in global trade, it would gradually move toward a more open capital market and adopt greater democratic values. Regrettably, this transformation didn't happen. As stated in the Journal of International Business Studies in January 2023, and I quote, the White House attitude toward China has shifted from a long-held expectation of a fully liberalized and democratic China following an open, inclusive, and cooperative bilateral relationship in the beginning to one that views a country as a threat that needs to be contained today, end quote. So not only did this transformation fail to occur, the trade imbalances between these two nations expose and magnify these ideological differences. Some argue that the unfulfilled expectations in the US regarding China's political and economic reforms reached their peak during the outbreak of the US-China trade war in 2018. By that time, if you recall, trade deficit reached a staggering 420 billion. Now in 2022, the latest data we have, it has dropped to 382 billion. The low was sometime in 2020 during the COVID, just about 310 billion. Now this trade war, also known as the Great Decoupling, in 2018 under President Trump, continues to this day under President Biden. Trade as a share of each country's GDP has also been weakening, especially in China. You can see on this chart, the red bar. However, it's essential to note that the geopolitical tensions today have been driven more by the US techno-nationalistic policies, which aim to safeguard its technological leadership and hinder China's ascent. This decoupling, now referred more as a de-risking by the US, is particularly focused on sensitive sectors like information and communication technology. In fact, US foreign direct investment in China in 2020 had halved compared to its peak in 2008. Most recently, the US has further restricted new investments in China's cutting-edge technology sectors, including semiconductors, quantum computing, and of course, artificial intelligence. Naturally, with these politicized economic policies, there was a greater urgency for industries to leave China, fragmenting global trade and driving regionalism. TSMC, Taiwan Semicon Manufacturing Company, the world's second largest, most valuable semicon company, has moved several of its outfits from China and Taiwan to Japan. And most recently, Bloomberg reported that the company is looking on a third factory in Japan to produce cutting-edge 3-nanometer technology, making Japan, here it is, potentially a global chip-making hub. Many relocating industries also ended up in ASEAN. Consequently, we have seen regional trade activity rising quite substantially. In fact, at a compounded annual growth rate of 20 to 30% in the last couple of years, and compared to just about 10% in the past 10 years. Now, a study conducted by the WTO that measured the impact of trade tensions hypothetically classified the world into the Western and Eastern blocks. You can see in this chart here, the Eastern blocks encompasses China, most of North Africa, and Southeast Asia. And this classification was based on the similarities in their foreign policies. Consequently, since the beginning of the Ukraine war in February 2022, the flow of goods trade between these two blocks has expanded at a slower rate than within the blocks, by an average of 4 to 6%, affirming that trade regionalization is happening. So what this means to global trade? Well, trade flow should remain, but at a moderated level going forward. I think this regionalism will continue due in part to more firms opting for the just-in-case production model rather than just-in-time previously. In the midst of this fragmentation and rising trade regionalization, the APAC real estate capital market continues to gain more share of global transactions. You can see the red bar in the left chart. While APAC investment has slowed in recent years, APAC cross-border capital, that is intra-regional capital, has been growing, while those of the global cross-border capital shrank as foreign funds remain home biased. And the black and the orange line on the chart to the right illustrates that. Now, APAC economies as well as the real estate market have clearly benefited from earlier periods of global integration. The region still possesses fundamental strengths that will, in my view, continue to drive growth in both investment and consumption. These factors, of which there are 5, include: 1, a large population with substantial young working cohort that provides the demographic dividend for sustaining growth will continue to fuel the APAC economic powerhouse, although challenges like youth unemployment must be addressed. 2, rising consumption due to middle-income growth and increased affluence will drive further demand for e-commerce and retail. 3, APAC is a consumer and an early adopter of technology. Digitalisation has driven economic transformation and the demand for supporting infrastructure, especially data centers. 4, the emergence of internet natives in the workforce will continue to lead increased digital-dependent consumption, requiring expansion in logistics assets and services. And lastly, while the population in many APAC countries is young and consumption will continue to rise, there is also a growing pressure from aging populations in South Korea, Singapore, Thailand, and China. So over the next decade, this cohort of retirees will expand, creating opportunities in healthcare, senior activity centers, retirement homes, and lifestyle villages in urban areas. So to summarize, while investments have slowed recently, cross-border funds, that is those intra-regional capital within APAC, have picked up, which suggests a deeper, resilient regional capital market environment. And aside from office and retail, industrial and accommodation-related assets have drawn more institutional attention recently, if you look at the purple bar on the left chart. Now, the developed markets such as Japan and Singapore will continue to be favored by cross-border capital. With that, I end my discussion, and let me hand over the floor to Amélie, who will share with us an update on the private fund market.
Hi, thank you, Dr. Chua. Good afternoon, everyone. As Dr. Chua has presented, we are in a certain time, in a new economical and geopolitical environment, and this is not without any impact on real estate investment globally and in Asia Pacific. In this context, I'm going to talk about investors' intention in APAC, what investors want, what are the trends, what are we seeing, and concludes by the performance. This is mostly based on the 2023 investment intention survey. The 2024 survey is going to be released next week, so I'm trying not to disclose too many of the findings so that you can still attend the event. We are going to talk also about capital raising and cover a couple of the indices covering performance of the region. So global trends in 2023 have impacted institutional investors. Macroeconomic factors such as high interest rate environment and inflation have been quoted by investors from all domiciles as impacting their investment decision in 2023. The sticky US inflation that was just published yesterday is actually likely to reduce the chances of an early Fed rate cut, so that we can still expect that it will impact real estate investment at the beginning of 2024 at least. Geopolitical risks haven't disappeared, and denominator effects impacting mostly European investors and North American investors neither. So those factors are likely to impact again real estate allocation in 2024. However, real estate has gained its role in a multi-asset portfolio, and we are not expecting a big drop in allocation. We could actually expect that the denominator effect will impact investors' changes in allocation, but it's not impacting Asia Pacific as much as other regions. On average, 70% last year were planning to increase allocation to the region. The most bullish were European investors. A lot of investors still need to build their portfolio in the region for diversification, even though they might decrease some allocation to other parts of the world. Asia Pacific investors are the one indicating the highest percentage of decreased allocation to the region, but it's also actually the sign of a shift to allocation to other regions as well. Obviously, that is also independent of the pricing of real estate, which we have seen has impacted quite a lot transaction over globally, but also over the region in 2023. Some sectors and markets have been nearly immune to it. So covering Asia-Pacific investment. Investors have indicated that for 2023, they will prefer to invest in Australian cities, Sydney and Melbourne, and Tokyo. This is not really new. We've seen this top three for a couple of years now. However, this predicted order could be challenged right now. What we've seen this year is a much bigger, higher focus in Japan than in any other location in Asia for obvious reasons. Japan is the only location in the world, apart maybe from China, where interest rates are low. And on the other end, because valuations haven't moved so much in Australia over the year, pricing of real estate there made it very challenging for investors to deploy capital. But, and I will mention that later, that the December valuation that we just published finally moved significantly, and maybe we can expect the market will recover in the first half of the year. This chart is showing the preferred investment destination in the region over the past 4 years and including a 7-year average. This is really to highlight that we've seen some changes in investor preference in the region. China Tier 1 cities has been part of often the top 4 or 5 investment preferred destination in the region, but in 2023, institutional investors were only 21% to say they will invest in the market. And we can expect that intention in 2024 will still be low, as conditions have not yet really changed in terms of obviously geopolitical environment, but as well on the economy. On the other hand, India intentions intention to invest in India were higher than the 7-year average last year. The level of foreign investment that has been seen in China is not only reduced on real estate, but globally as well, for other investment as well. 2022 was the first year to see a change in the top preferred sector when investors placed for the first time on record the industrial and logistics sector as the most preferred sector for institutional investors in the region. 2023 was another first, with the residential sector taking the first spot. A couple of comments here. The interest for industrial started really in 2018 in the region. And at that time I was saying, yes, everyone wants to invest into China logistics, but it's not that easy to access. So I will say China logistics not any more preferred sector combination, but still the sector is very much on demand. Residential as well. The residential sector was actually tied for the second place with the office sector, but that's very new for the investment intention survey. Meanwhile, and that was also the first time that office sector has lost its first place as the preferred sector for investment in the region, in a record low in 9 years. Obviously, a couple of impact here from COVID pricing. Obviously, what's happening in the US as well is not helping the image of office, even though we all agree that the conditions and situations of office market in the region are very different. What I want to show here is going back to actually the current investors' allocation by sectors. And this is by investor domicile. So on average, on the right hand side, you have all institutional investors' portfolio allocation. And you can see that office on average is still 32%. But if you look at the North American allocation, you see that actually office and retail is only 19 and 10%, where residential and industrial and logistic is actually the highest allocation to 27%. We often say that there is obviously a trend in investors from Europe and Asia-Pac to follow the North American allocation or strategy. A couple of years ago, the ODC index in the US was actually not covering that much or including that much in your residential property. So we believe this is going to change as well in Asia-Pac, the same way that the industrial and logistic allocation may still increase for European investor and the office allocation to decrease for North Asia-Pac investor. Talking about how we access the market in the region. So a couple of years ago, we were saying that joint ventures and club deals were the main favored route to market. But at the end of the day, every year we find that the non-listed funds are still the way investor will increase their allocation to the region. A couple of reasons to that. First, offshore investors, so investor from Europe or Asia-Pac will still favor funds over more direct approach, as they might not have office on the ground. Asia-Pac investor will likely go for more direct access to the market, so joint ventures or directly owned real estate, or even some separate accounts as well. Moving now to some of the trends we've seen in capital raising. So what to expect in an uncertain environment? The data for 2023 is not yet available, I'm sorry, so I'm just going to show 2022. We were surprised to see that it was still very high, but this year probably no one told me that it was easy to raise capital. So I will say that's probably, we'll see a big drop. I don't know how big it's going to be. We'll have to wait until the survey is going to be released in April. We think it might be showing a big drop in capital raised everywhere in the world. However, and I just want to again quote 2022 data, what we've seen is that for single sector strategy found in Asia-Pac in 2022, industrial and logistic were the one raising the most, followed by residential and multi-family vehicles. So those two strategies definitely are the most appealing for investor in the region. Moving to performance of the funds in the region, I just want to give a brief overview of how Asia-Pac is doing versus the rest of the world. So obviously, returns have been challenging for the past 2-3 quarters, and the Global Real Estate Fund Index, together with that we published together with NCREF and ANREV, is showing a big drop in returns. But if we look at the 1-year rolling return, or 3 or 5 years, you can see that Asia-Pac returns are still all right, are still better than Europe, slightly lower than the US. And just to maybe explain a bit of those returns, you can see that the US performance here is covering much more industrial and residential again in the sector compared to Europe or Asia-Pac. So those two sectors recently have been performing slightly better than others. If we look now at the Australia Co-open Fund performance, I have mentioned at the beginning that we've seen a bigger correction, and finally in December, index that was just published actually today, compared to a previous quarter, and everyone was really waiting for the valuation to go down in Australia. So we hope that is going to maybe help with a few transaction again in the beginning of this year. If we look at the different single sector fund here, office, retail, and industrial. So industrial has been taking a bit of a hit in the last quarter, as well as office. But again, I think it's really a repricing of assets. And retail is slightly more resilient, but as you can see, again, retail has been hit previously. If we now look at what we have as a proxy for asset level performance, and I just look at a very small sample, which are the assets owned by our ODC funds, so the funds, the co-open fund in Asia Pacific, you can see again that the returns of industrial assets versus office and residential is slightly higher, but residential again is holding well. So that's again a small sample, because as you can see, the market value is not even 20 billion. And we can also have a look a bit deeper into Japan, where we have the 3 sector also coverage. Obviously, the sample is even smaller, but you see that the office market is actually doing kind of okay in Japan, slightly better than the other 2 sector in the last quarter. Industrial, logistic, and residential are returning the same. So that gives a bit of a really eye picture on the region, what investor wants, and how the market is performing. That's the end of my presentation now. So I will hand over to Josh. Thank you.
Thanks, Amélie. Thanks, Dr. Chua. As Dr. Chua mentioned, our region here in APAC represents 41% of global GDP and over 50% of growth. Nearly 90% of middle-class population growth is stemming from APAC, which is projected to create an incremental $10 trillion consumption engine over the next decade. Additionally, the region's home to over 3 billion digital natives, approximately 5 times that population in the US and Europe combined. These factors are some of the drivers that have propelled a period of strong expansion in the APAC industrial market, driven by rising demand and an undersupply of modern logistics assets. But as Amélie her survey data just showed, that while industrial has been an outperformer, investors are concerned about inflation, rising rates, and geopolitical tensions, and have slowed deployment significantly. Well, fortunately, today we've got a great panel of leaders to hear about what's really happening on the ground across our major markets. And if I may, we'll start with Phil talking about inflation and interest rates dynamic. Phil, based on the recent CPI data released in Australia, it appears that inflation is starting to moderate, although still a little bit above the Reserve Bank's target range. Rates are up over 400 bips over the past 18 months from nearly 0% base. What's your view on where rates go and what impact this will continue to have on the investment market and cap rates in Australia?
Yeah, thanks, Josh. Look, there's obviously over the last 12 months, and then even a lot of debate about when interest rates were going to hit their peak, and even now with inflation looking like it's peaked and starting to come down, I think some of the banks in Australia are still saying that there won't be any interest rate cuts this coming year, and others are saying there will. So it's obviously quite divergent. I think it's early days. The inflation numbers that came out the other day are just above 4%. The RBA target is 2 to 3%. I think the RBA will want to see inflation well within that range before they look at cuts, and they will also want to see what is happening with unemployment. Australia is enjoying very high levels of employment, and unemployment has started to tick up, and I think we probably need that to tick up a little more. Personally, I think we will see 1, maybe 2 interest rate cuts this year, which is obviously going to be good for the market, because investors have been finding it difficult to price assets, to understand what their cost of capital has been. We've never seen such interest rates rise so quickly in recent times. So that's had a real impact on transaction volumes. I think with investors, with that looking like it's peaked, and as Amelia mentioned, we've started to see some asset price correction in Australia. Hopefully that means that we'll start to see transaction volumes increasing as investors have more confidence around what their cost of capital. So I think in summary, I expect perhaps the back end of this year to see 1 or 2 interest rate reductions in Australia.
Okay. And Stuart, continuing on with kind of the interest rate inflation rate theme. Japan obviously has super low cost of debt still, and arguably have the highest yield spread in the world in terms of kind of cap rate versus interest rates today. And that's, as Amélie mentioned, has attracted a lot of investor interest in Japan, particularly in logistics. But there's been some inflation, at least Japan-style inflation in the market, and there are fears of BOJ tightening. Is now a good time to invest in Japan?
If you go back to 2020, the Japanese government back then was targeting 2.5% inflation. It never achieved that target. In fact, for most of those years from then until now, they were getting deflation. Probably of 12 out of the last 20 years, they were getting deflation. So suddenly in 2023, they hit that 2.5% target. I think currently inflation is covering about between 2.4 and 2.6 or thereabouts. So there's a lot of speculation in the markets about what the BOJ is going to do. And if they do something, it will probably be April, the beginning of the new fiscal year. I really don't think they'll get much latitude to push rates too high. You're definitely not going to see 2 consecutive quarters of 75 bips that you saw in the US or maybe even Australia. I don't think you'll see that. They just don't have that latitude. I personally don't think they'll put rates up at all because they're in a bit of a quandary. They've been targeting this 2.5% inflation for 20 years. They've suddenly hit it. The economy is doing not bad. Actually, you know, relative to the rest of the world, it's doing not bad. So I don't really think they're going to do much, you know, anything that could imperil that delicate balance now. And also the TANCAN, which is the Confederation of Japanese Industries, is a very, very powerful lobby group. They've made it very clear to this current administration that their members won't have any high tolerance for any excessive interest rate increases. So you might get 25 basis points, maybe, possible. I personally just don't think it will happen. More of an issue in Japan for our business and for developers in general is just commodity inflation. It's construction price increases. I mean, getting this across all of our markets, I think we've seen probably somewhat 37% construction cost increases in the last 2 years. I mean, that is more impactful than potential 25 bips increase in interest rates. That has had an impact, obviously, in development margins, you know, but fortunately in Japan, you know, we probably do more rezoning than anyone else. So every year we'll probably get between 50 to 100 hectares of rezoned land coming off the production line, which gives us a very low land base to go in with. It just, the whole process takes several years. But when you get there, it definitely pays dividends. But the way I see the market going, and this could apply across all of our APAC markets, I think they're going to see construction slowing down, which is going to impact demand, which I think is going to keep demand very tight. I also think you're going to have overproduction in commodities. So, you know, some of the big commodities that cause a surge in the construction costs are steel and cement. So I would see that there's going to be a slowdown in construction across APAC, which is going to help. You know, it's going to help definitely on the supply side, because there'll be tightening supply, which is better for us because there's going to be, you know, much less supply going around. And as I say, I think because of that potential construction slowdown, you're going to have overproduction of steel, cement, and other commodities, you know, make up, you know, these great buildings that we produce. So I'm hoping that's going to put pressure on construction prices, and we'll actually start to see construction prices soften during 2024.
Have you started to see that yet? Just as a follow-up, you know, given the slowdown in China and obviously the lull in new starts in China, who's been a huge consumer of the raw materials, have we started to see those prices flatten out and come down? Not yet.
Well, I mean, they've definitely spiked, peaked, and flattened. Yeah. I mean, for sure they're flat. We haven't seen any movements in construction costs for the last probably 6 or 7 months. And we're just looking, you know, for signals that, you know, prices are going to start softening. But as I say, I think one of the drivers of that thesis is probably going to be overproduction in the steel sector, which is a big, you know, is a costly component of the stuff that we do. It hasn't kind of fed into the system yet, but I'm highly confident that we'll start to see that feed in probably the second or third quarter.
But moving to Jay, you know, I know the markets in Southeast Asia are diverse, as are the inflationary and the interest rate environments. You know, but one of the things that investors talk to me about in these markets also is key derivative of that dynamic, which is currency. And so, you know, how do you think about that risk for investors in the Southeast Asian markets, especially in this environment of higher rates?
Yeah, I think that one of the outcomes of data that we have over the last, let's say, decade or so, when you look at each of the Southeast Asian markets, Singapore, Malaysia, Thailand, Philippines, Vietnam, and Indonesia, the data actually shows that currency risk or currency devaluation over the last decade and a half has been fairly muted. I mean, the most at the upper end of the spectrum, you have Philippines, where it's about 2% per annum, if you look at the last decade or so, and then you have Singapore and Thailand, where there's been almost no currency fluctuation. I mean, there have been blips. There was a little bit of a run up as interest rates in the US went up and some of the markets in Asia didn't move. So there was obviously a flight to the US dollar, which led to some currency fluctuation in some of these markets. But if you take the data into account and factor that into your investment decisions and say that in any of these markets you're going to have, let's say, 1% per annum or 1.5% per annum, which is probably the right number for markets like Indonesia as well as Vietnam, and factor that into your investment decisions, I think you can still make intelligent sort of investment decisions for taking into fact that growth, of course, is higher in all of these markets compared to the rest of APAC, but frankly, globally as well. And so, from a long-term investment perspective, when you juxtapose the currency devaluation versus growth, I think you can still make a strong case for investing in Southeast Asia.
Well, and along those lines, Jay, back to Dr. Chua's and the whole kind of theme of today of the trade fragmentation. I mean, Southeast Asia is obviously a beneficiary here as shifting economic growth, and reshoring goes into the subregion. I mean, what are you seeing on the ground, and you see it, sustaining into 2024?
Yeah, I mean, I think Southeast Asia has seen an influx of industrial activity, not just from China, but across the globe. And frankly, this move predates, any of the US-China trade and tariff wars. And, the move actually is driven primarily by labor cost differentials between, China, which has been the world's sort of, factory for the last few decades. And now you have countries like Vietnam, Indonesia, Thailand, where labor costs are lower. I think the tariff moves have actually added another variable to the equation and hastened some of these moves. So we've seen a lot of large requirements come in over the last 12 to 18 months on the industrial side. And I think that this demand will continue not just into 2024, but over the next 5 years, if not longer, as companies reconfigure their operations, their supply chain to benefit from these lower costs in Southeast Asia. But the longer term opportunity, Josh, I think across Southeast Asia is the growth, right? You talked about, the middle class, you talked about, native internet users. So with this increasing urbanization, internet usage rates, I think that the demand for driven by domestic consumption, both for distribution as well as data center spaces in this region will grow. So if you're looking at a long-term view over the next decade, I think that you will see the secular trend play out in your favor.
Yeah. Phil, going back to Australia, I mean, obviously there's been some fairly highly public trade spats between Australia and China, again, back on the fragmentation tangent. And China's Australia's largest trading partner. But it doesn't seem to really have impacted demand for industrial, and in your major markets are some of the tightest in the world, vacancy rates less than 1%, generating unprecedented rental growth. I mean, what's driving the demand?
Well, so first of all, we talk about the trade tensions between Australia and China. The majority of our trade actually revolves around iron ore, and that hasn't been affected. I mean, the producers of wine and growers of barley have been affected by those trade tensions, but the majority of the economy and what drives the Australian economy hasn't really been affected. And so in fact, the demand for iron ore out of Australia has continued to be very, very strong. And the government is talking about having a significant surplus this year, and that's been driven off iron ore, and once again predominantly from China. I think and then so that has held the Australian economy in really good stead, and it's actually relatively strong. And I think the rental growth that we have seen, you mentioned in the Australian market, I think COVID had a couple of factors. We had, and Dr. Chua mentioned it before, about people moving from just-in-time deliveries and inventory levels to just in case. So we certainly have had inventory level build up quite deliberately to future-proof supply chains. So that's been a factor. The other thing is Australia has been a slow adopter of e-commerce, and COVID actually forced Australians to shop online. So, you know, China, the US, so most developed countries and even developing countries had higher penetration rates of online shopping versus Australia. So Australians have been forced to shop online, and have sort of come to understand the convenience of it. So I think that's a trend that will continue. And, you know, the online end users or online companies have been taking up a lot of space. So I think ESR Australia, and if you look at ESR Australia and Logos combined, I think we probably lease close to 400,000 square metres to one of the major online shopping platforms in Australia in the last 12 months. Now, they've done that with us. They're not just going to be talking to us, they're talking to others. So that's been very, very significant. And I think that will continue, Josh. I mean, Amazon entered the market in Australia basically 2018, and they've really started to get traction now, and their space requirements have picked up quite a lot. So you've had that, you've had a shortage of land, so land supply has been quite tight. So as the demand has been twofold, and that's led to rental growth, and then also at the same time, people haven't been able to bring on supply quick enough to satisfy the demand. So that's really been the drivers there, Josh, in terms of the rental growth. And the trade tensions between China and Australia have really been a sideshow, because it really hasn't affected our main trading commodity.
You talked about kind of the future proofing of supply chain and e-commerce being a big demand, you know, for this. I mean, we talk a lot, obviously, in the business about modern logistics and the dearth of modern stock in Asia in particular. I mean, you know, Stuart, I mean, you've been developing modern logistics in Japan for over 20 years. I mean, how have the demands and new technologies changed the specs over time? And what are tenants looking for today, especially given that they have more choice because there's an uptick in supply?
Yeah, I mean, just to answer the first part of that question with regards to how has the product that we're producing changed, you know, taking into account the technology which is coming into the business of the customers we serve. You know, it might surprise a lot of people, but Japan has been a real laggard when it comes to the uptake of automation and robotics inside distribution centers. Even some of the latest ones that, you know, we've developed in 23 and 22 to the world's largest e-commerce players, you'll still see it's very much a manual operation. It's people walking around with trolleys, picking stuff from racks and putting it into boxes for fulfillment. The way the boxes move through the facility, you know, it goes on to an automated process. But when I contrast that with some of the stuff that we've done in China, I mean, in China, we truly do have dark warehouses, and they say dark because you don't need lights because they're so automated. There's no people inside some of them, so you don't really need lights because robots don't have eyes. So Japan is very much a laggard, but coupled with you know, late uptake in technology and automation, you've got a chronic problem of a shrinking workforce. You've got very, very little immigration, and you've got an aging population. So all these fundamental factors are definitely going to have to drive that change to more automation. So what I expect to see in the future, and as Dr. Chua mentioned earlier on, You know, there's a move to make Japan the new global chip making hub, which is great. Japan really lost its mojo, 30 years ago when it comes to high tech and semiconductors and very much high technology process manufacturing. A lot of that was offshored about 30 years ago, but now you start to see quite a bit of that coming back. Again, is potentially a result of some of the trade tensions and deglobalization around the region. So to answer your question in a very long-winded way, we're seeing buildings are getting higher. The stuff that we're doing now resembles more the sort of product you will see in Hong Kong. We're doing 9 floors. When I started here in Japan 21 years ago, 4 stories was the normal. We just completed a 9-story building. We're going to start another 9-story building shortly. So you're seeing higher, you're seeing more densification. You're seeing higher roof heights, ceiling heights. The basic fabric of the building, surprisingly, again, the basic fabric of the buildings in Japan hasn't changed that much because the Japanese are being quite laggard, as I say, when it comes to automation. So I expect that will change over the years to come because, when you're faced with a workforce which is dwindling and aging, you're going to have to become suddenly going to pivot to a rapid adoption of technology and automation. And we do start to see that in some of our warehouses, but we have to cater to current demands. And basically that hardware is supplied by the tenants. So we have to actually see what they're going to introduce into the warehouses. But we have actually saw it with some customers now that are really just taking more of an approach to technology and much less manual workforce. But again, when I contrast it with, some of the stuff that we're doing in Australia right now, and Australia, as Phil just said, was late to the party when it comes to the whole adoption of e-commerce. I think Phil mentioned that Amazon only got there about 10 years ago. When I was a visit to Australia recently, some of the stuff that we're doing now for the e-commerce players is the technology which they're incorporating into the fabric of our structure is 10 years ahead of what I've seen in Japan. It's more on the level that you see in China. Very high rates of very technical, sophisticated automation. So I think now the driver of that in Japan is going to be necessity because basically you're going to run out of workers. The current rate of basically of birth rates and death rates, which I could go into, but that's for another conversation. So in short, the way I see it going in the future, Japan is probably ahead of the rest of the Western world with its regulatory environment for drones and drone delivery. I would see that you'll see drones operating from our buildings. We've already built some buildings which are hardwired for drones. The pads are already there on the rooftops for charging. The technology is definitely there to have autonomously operated drones, but I think you'll see that coming into becoming a part of the firmament of the whole supply chain in Japan in the next 5 years. The regulatory process is pretty much advanced. They're looking at basically corridors through Tokyo, but they don't want packages falling in someone's head. So looking at drone corridors above the railway tracks or above canals, or basically just skirting the bay, so you're not actually flying over a high density area. So I think drones, you'll start to see drones in the skies of Tokyo in the next 5 years because you've got a fairly advanced regulatory process. Drone technology has been there for the last 10 years. You're going to see a lot more automation. Buildings are getting higher, but something they really, really need to change in Japan is basically the urban planning laws, because we're pretty much stuck with a 200% floor area ratio, which basically means you can build twice as much net rentable area as the land parcel you're building on. Generally, for our sector, logistics is 200%. We've rezoned a couple of pieces of land to 400%, which is why we can get a 9-story building. That has to become more of the normal. In Japan, they really, really have to revisit the urban planning laws, which were basically drafted before the Second World War, so we can get 20-story warehouses, such as the like that you see at Interlink in Hong Kong, which I think is 22 stories. So for the future of logistics real estate in Japan, I think it will have a much higher adoption of technology, but they will get higher as well I think we're going to go beyond 10 stories in the next 5 to 7 years as urban planning laws do get changed. And it's necessary as well. It's a greater source of fiscal revenue per square metre for the government as well. So I'm sure, but things happen very, very slowly in Japan when it comes to urban approvals.
Yeah. Well, I mean, as predicted, I guess I have a long list of questions in 7 minutes. So I think that what I need to do is probably wrap it up. It's rare that we have, 3 of the business heads, regional business heads for ESR on the call. And there's a lot of investors on the call that I'm sure have a lot of questions. And maybe I'll just turn it over back to Tice and we can moderate some Q&A. But thank you all for your participation.
Yeah, okay, thanks, Josh and the panelists for your insights so far. So we did receive some questions from the audience. We will begin the Q&A session now. So as a reminder, you can still put in your questions via the Q&A feature on your Zoom screen. So the first question is for Stuart. It's about China. I'll combine some questions. It says, you guys have a big business in China. Are you concerned about the current market situation? And also, what is your view on the opportunities and challenges for the logistics sector in China?
Yeah, let me just set out the facts here. Relative to the rest of our markets across APAC, we don't have a very big business in China. I think that's sometimes taken a little bit out of context. I mean, if I look at our development starts, probably that's a good metric to use. If I look at development starts across the group for 2023, it's coming in above $7 billion US. Okay. Again, to give you context, of that $7-something billion, and we're still finalizing the 2023 numbers right now, but of that $7-odd billion, less than $1 billion was started in China last year. In fact, if I look at Australia and New Zealand, they had more than double the development starts of China. So, I think there's a little bit of misinformation there that we are a China developer. We've got a great business in China, which is basically focused on southern China and the Shanghai area, which are still the areas of growth. I mean, probably another good metric, if we look at our management fees across the whole of the group, less than 8% of our fees were accrued from China in 2023. So again, I'm just trying to kind of give people some context, and if they think that China's got problems, that the ESR groups get problems. The current situation in China has not been overly impactful on our business. We're definitely concerned about any noise that emanates out of China when you hear about geopolitical tensions between the US and China, which Dr. Chow touched on earlier on. That's always something you have to be wary of. But in terms of, the areas of focus for us, the Greater Bay Area, which is, it's still got a growing cross-border e-commerce business. Some of the other drivers which are basically helping us pivot our strategy somewhat. You've got a new strategy that we've adopted for China is an urban renewal strategy. Now, the logistics sector only really started in China about 20 years ago. And most of that 20 years ago product was single story, and a lot of it was not great quality. We're now seeing opportunities, good value opportunities in buying some of that, and basically going from single story, fairly not great stock, to making it state-of-the-art multi-story stock. So we're now pivoting our strategy to an urban renewal strategy. Life sciences is an area which we're very focused on. We've got the Changchun Park in Shanghai, which we're working on right now, and we think that's going to be a great growth sector. But we're also focusing on the main drivers of growth in China, which if you look at right now, I mean, I think there was a statistic that came out last week that China is now the #1 manufacturer of EV vehicles globally. Now, you've got the EV vehicle industry, which is growing. You get renewable energy, which is growing across the world, or the demand for renewable energy is growing across the world. Now, 90% of solar panels are made in China. So that industry is still growing as well. So those growing industries, they still need the supply chain. So we're focusing on basically being the real estate part of that supply chain. So for us, there are issues, there are pockets of China, certainly in tier 2 and in tier 3 markets, which we don't have any assets in. we just wouldn't touch these areas. But some of our competitors do have excess supply in those areas. Fortunately, our activities have always been restricted to tier 1 and tier 1.5. So, there's been a softening in demand, and there's been some pockets where rents are under pressure because there's been excess supply. But when we look at the Pearl River Delta and the Yangtze Delta and the Greater Bay Area, for us, that's the main areas of focus. And our levels of occupancy are still quite healthy in those areas. They're certainly within tolerable levels compared to our peers.
All right, thank you, Stuart, for that clarification. The next question is for Jay on Southeast Asia. So Jay, besides Vietnam having benefited from regionalization of trade, are you seeing any other hotspots emerging in Southeast Asia? Which countries do you see have a good outlook?
I think across the region we seem to have a fair amount of uptick in activity. Singapore has seen record levels of low vacancy over the last year and a half that has led to a massive increase in both rental values and capital values. If you look at the 2023 numbers recently published by CBRE, there was about a 14% increase in prime logistic rents and a 7% increase in prime logistic cap values for Singapore. Apart from that, I would say in Thailand we've had a large number of starts on the industrial side, right? So one of the anecdotes that I think is pertinent to share is that we recently started a project for a electronics manufacturer that's moving their production from Suzhou to Bangkok. And the CEO of that company shared with us that they expect to see a 30% reduction in production costs by making this move when that facility is ready in April of next year. We've had a lot of demand in Indonesia as well. It's different sectors looking at these markets from their own lens, for certain input, right? So in Thailand, the number of engineers and high quality engineers that Thailand produces draws a lot of slightly higher spec industrial. Vietnam has the lowest labor costs and has also got the closest proximity to China. So that's where you see some of those larger volume activities move from China to Vietnam.
I mean, interesting what Jai was saying there, because our businesses in Southeast Asia, they've always had that component of logistics and some light manufacturing. Now we're starting to see quite a bit more of high-tech manufacturing. So probably for our Thai business, which is very much in its nascency, but for our Thai business, we're probably doing half high-tech manufacturing, half logistics. Certainly for our Vietnam business, which has been going for a few years, again, it's probably 50-50 manufacturing, 50% logistics. And again, get back to Dr. Chow's point, Japan, maybe as a result of deglobalization, you're starting to see manufacturing coming back to Japan. We will be targeting those industries in Japan as well, manufacturing as well. More a kind of mixed use type model in terms of business park, as opposed to just straightforward core logistics.
All right, thanks, Stuart. Thanks, Jay. A few more questions. We almost have to wrap up, so I'll ask 2 or 3 more, and then if we can keep the answers relatively short, we can cover a few. First one is for Phil. So Phil, some investors see the current environment as a good time to invest. What are your thoughts for that, specifically to the Australian market? What's your view?
Yeah, so that's a good question. I think there are a couple of things. I actually think it is a pretty good time to invest. The Australian dollar initially is quite low, so that obviously presents for offshore capital a reasonably good entry point at the moment. and the fundamentals, so we still got then fundamentals of the real estate market. So we've still got nearly full occupancy. So while we're not going to see the 40% per annum rental growth we've seen over the last 2 to 3 years, I think we're still going to see high single digit or maybe low double digit rental growth. So I think that's obviously a good fundamental. And as coming back to something Stuart touched on before, what we are seeing in Australia at the moment, actually construction costs have actually started to come down. Certainly in Melbourne, and we certainly have seen them peak in Sydney, and we're expecting that maybe they have started to come down. So I think there's a couple of things there, and the supply side from a land perspective is reasonably constrained. So fundamentally, and the economy, I mentioned before, the economy is still reasonably robust considering the speed of interest rates that we've had. So overall, we think it's still a good time to enter the logistics sector in Australia.
Okay, that's clear. So really the last question then, quick one for Stuart on cold storage in Japan. So the question is, what are your views on the opportunity of modern cold storage logistics in Japan? Is there an opportunity to invest in this sector?
Right. I don't give quick answers, so you're asking the wrong guy. But it's very much an owner-operator model. I mean, in Hong Kong, we're doing the largest cold storage but it's been built for the last 30 years. In Japan, it's very, very much an owner-operator model. And, we've tried to get into that sector by doing sale-leasebacks. We find that the few customers in that segment are very resistant to that. They want to own their premises. They want to own the technology. So actually, it's something that always shows promise, but it's very, very hard to penetrate. And it's something you would never speculate on as well, because there's so much. It's a very, very technical building in terms of its design. You've got zones for -40 and zones for +5. So it's how do you apportion the zones? So we're keeping an eye on it, but it's very much a build-to-suit opportunity. It's not something we'd speculate on.
Okay. Yeah. Thanks. So with that, we have come to the end of today's session and the Q&A. So on behalf of ESR Group, I'd like to thank you for joining us today. We hope you found the session of interest, and we'll make it available on the website as well for later viewing. So many thanks to all, and goodbye.
Thanks.